Brent crude just exploded 4% in a single session. US strikes inside Iran, Hormuz Strait shipping fears, the headlines are terrifying. And right now, every retail trader is seeing that spike and wanting to chase this move higher. But here is what the interbank order flow and the technical structure are actually screaming. We are coiling inside the most dangerous bear trap I have seen in 3 months, and one single level, $99.29, is the line that separates a full geopolitical melt-up from a violent collapse back to 91.84. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end because I am giving out 3 exact entry and exit levels you can use right now. The instant verdict on this Brent crude session: the bias is a fading rally, but only if we stay below a critical invalidation zone. We are dealing with a collision between a weekly buy structure and a daily strong sell signal. And that collision always produces a trap. The short-term spike is real, but the daily trend is firmly bearish, and the 1-hour chart is already showing exhaustion. I am declaring this a range-topping environment with a high probability of mean reversion. Write this number down. If Brent crude closes above $99.30 on the 4-hour time frame, the entire bearish structure shifts, and we switch to a full-blown momentum chase targeting 100.86 and beyond. Until then, the selling pressure is the dominant force. Now let's walk through the chart from the top down so you see exactly what I see. On the weekly chart, Brent is still in a buy structure. The weekly moving averages confirm this. The 20-week and 60-week moving averages are sloping higher, and price is currently holding above the 60-week average, which sits right near the 91.84 support zone. That is not a coincidence. 91.84 is the weekly value area low, and it aligns with the 60-week moving average. That level is the floor the market must defend to prevent a full trend reversal. As long as we hold above 91.84 on a weekly closing basis, the macro bulls are still in control, and this spike makes sense as a liquidity grab within that weekly uptrend. But here comes the trap. Drop down to the daily chart, and you see a completely different picture. The daily trend is a strong sell. The 20-day moving average has crossed below the 60-day moving average, and price is currently trading below the 200-day moving average. The 200-day is sitting at 98.70, and it is acting like a brick wall. Every rally towards that level over the last 2 weeks has been sold off aggressively. The daily MACD is in bearish territory, and while we are seeing a slight tick up from the signal line, there is absolutely no bullish crossover yet. More importantly, the MACD histogram on the daily shows us something crucial. It is printing higher lows while price has not yet made a higher low. That is early-stage positive divergence, but it is not confirmed. For it to become a real buy signal, we need to see the histogram cross above the 0 line, and we are nowhere near that now. Zoom into the 4-hour chart where the real battle is happening. The 4-hour trend is neutral, and that is precisely why this is a decision zone. The 20 and 60 moving averages on the 4-hour are flat and converging. Price has just spiked above both of them, and we are now testing the 200-period moving average on the 4-hour, which lies at 97.62. That level has already been breached intraday, but we need to see a 4-hour close above it to even consider a bullish continuation. The MACD on the 4-hour is showing a classic exhaustion signal. The fast line has crossed above the slow line, but the histogram bars are already starting to contract on the upside. That tells me buying momentum is fading at the worst possible place, right below the major daily resistance zone. And that resistance zone is defined by the 2 highs we printed earlier this month, 99.29 and 100.86. 99.29 is the lower high that confirmed the daily downtrend. That is the level the sellers will defend with size. On the 1-hour chart, we are neutral but ticking into overbought conditions. The 1-hour 20-period moving average is sharply higher, but price is now compressing just below 97.50. That compression after a 4% spike is a redistribution pattern. Institutions who accumulated long positions during the initial strike news are now offloading into the retail buying frenzy. You can see it in the 1-hour MACD. We have a bearish cross pending, and the signal line is flattening. The key support on the 1 hour to watch is 96.20. If we lose that, the trap is sprung, and the move back to the daily support at 91.84 accelerates so the numbers you must have burned into your screen. Resistance is 99.29 and 100.86. Support is 96.20 on the 1 hour. Then the major daily floor at 91.84. And the pivot point of this entire structure is a 4-hour close above 99.30. That is the line in the sand. Now let's connect this price action to the fundamental driver, because what happened overnight is not just noise. It is a potential regime change in the geopolitical risk premium. US strikes inside Iran and immediate fears of Hormuz Strait disruption are the purest supply-side shock you can get in oil markets. The Strait of Hormuz handles roughly 21 million barrels per day of crude and products. Even the threat of a partial closure adds an immediate risk premium of 5 to 8%. We just got 4% in a few hours. But here is what most traders miss. This is not the first time we've had Hormuz fears this year, and in each prior instance, the spike was fully retraced within 72 hours once immediate escalation failed to materialize. Unless we see actual ship seizures or verified damage to transit infrastructure, the premium will deflate. The smart money sells the spike, it does not chase it. Now, cross-asset confirmation is vital. I want you to look at gold right now. Gold is the fear architect. If this Brent move were the start of a sustained geopolitical contagion, gold would be surging well above its recent highs and would not be hesitating at resistance. But what we are actually seeing is gold stalling and even showing signs of a small pullback. That tells me the safe haven bid is not broad enough to support a sustained crude breakout. The dollar index is also hovering near flat, with a slight bid. Usually, a true supply shock in energy sends the dollar lower on stagflation fears. The fact that the dollar is not selling off aggressively gives me further confidence that this oil spike is a tactical event, not a strategic trend change. The 1 to 2 week directional lean, I am bearish as long as we stay below 99.30. I expect a gradual deflation of the risk premium and a test of the 94 zone initially, followed by a drift towards the 91.84 support. The exact event that invalidates this thesis is a confirmed 4-hour close above 99.30. If we get that, I will flip to a bullish bias, targeting 186, and I will tell you in tomorrow's video exactly how to play it. Most people will click away now, but this is where money is made. Keep watching, because I am about to give you the 3 exact trade setups. Strategy 1, the sniper. This is the conservative, high probability short for traders who wait for confirmation. The trigger condition is a 4-hour candle close below 96.20, the 1-hour support I mentioned. We need to see the selling pressure confirm that the spike is fading. Additionally, we want the 4-hour MACD histogram to print a lower high versus the previous bar, confirming momentum loss. The entry is on a retest of the broken 96.20 level, but only if the retest holds as resistance and we get a 1-hour bearish engulfing candle. The stop loss goes at 97.55, just above the intraday high of the spike. That gives you a stop distance of roughly 135 ticks. Target 1 is 94.10, which is the next significant volume node and prior consolidation area. Target 2 is 92.50, just above the major 91.84 support, giving you room to take profit before the big test. The risk-reward on this setup is 1 to 2.6 to target 1, and 1 to 3.8 to target 2. This setup is voided if Brent closes above 97.55 before triggering. That invalidation means the selling pressure is not there yet and the trap could morph into a breakout. Strategy 2, the active trader. This is for traders who want to participate in the potential upside continuation but only with a risk-defined momentum chase. The entry condition is a 1-hour candle close above 97.80, confirming immediate breakout momentum. You enter long on a small pullback to 97.60, which is the breakout retest zone. Stop loss is placed at 96.90, just below the prior consolidation. That's a 90-tick stop. Target 1 is 99.20, just before the major resistance, and you must take partial profits there. Once target 1 is hit, move your stop to break even and trail it by the 20-period moving average on the 1-hour chart. Target 2 is 100.50, just inside the resistance cluster. The logic here is that if momentum continues, you capture the final leg of the spike without holding through the resistance test. But you must be disciplined. If price hesitates below 99.20 and forms a bearish pin bar, exit the remaining position immediately. Let's see how aligned we are. Type your Brent crude range for tomorrow in the comments now. I'm reading them. Strategy 3, the Aggressor. This is a counter-trend fade for high-risk traders who know how to lose small. The setup is based on the assumption that the spike is a liquidity grab and will reverse sharply. You enter a market short right now, near 97.50, but with a very tight stop at 98.20. Just above the 200-day moving average on the daily chart. That's a 70-tick stop. Target 1 is 95.80, the previous breakdown level. Target 2 is 93.50. The risk-reward on this is aggressive. You are essentially fading the news momentum without waiting for confirmation. Only take this if you are comfortable with a lower probability and high-speed whipsaws. This trade is invalidated instantly if we trade above 98.20. Never risk more than 1 to 2% per trade. No positions through high-impact news. Stops are non-negotiable. Here is the one critical level for the next session that overrides everything else. 96.20 on a closing basis on the 4-hour chart. That level must hold for any bullish argument to survive. If we lose 96.20, the bull trap is confirmed, and the path to 91.84 is wide open. Tomorrow, I will be watching the US weekly petroleum status report, but more importantly, any further headlines from the Strait. If the situation de-escalates, the trap will spring fast. If you want the full breakdown on gold and how its failure to rally alongside Brent is confirming this oil trap, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage. I'll see you in the next one.